Imagine a world where money is no longer physical, where the cash in your wallet, the coins in your pocket, the dollars you once could hold, are now just data points numbers floating in the ether. At first glance, this seems harmless, even convenient. Digital money promises speed, efficiency, and modernity. But here's the hidden truth. When money became digital, power became untouchable. The institutions controlling these numbers, banks, central banks, governments now hold unprecedented authority over the economy, over citizens' financial lives, and over wealth itself. And unlike the old days, when gold coins or paper bills were tangible, this new form of money is almost impossible for ordinary people to control or even fully see. Today, we're uncovering the hidden transformation from physical cash to digital money, tracing how this shift quietly consolidated power, why ordinary citizens are increasingly vulnerable, and what it might mean for the future. Setting the stage, background, and key figures to understand how digital money created untouchable power, we need to look at history. Money wasn't always just numbers. For thousands of years, wealth was physical. Gold coins, silver, and later paper currency backed by tangible assets. Owning money meant holding it. You could save it, hide it, or trade it. Power was distributed, albeit unevenly, but it was visible. Entered the architects of modern banking. Central banks like the Bank of England, the Federal Reserve in the United States, and the European Central Bank. Figures such as Paul Vorburg, John Maynard Keynes. And later, innovators in digital finance understood a profound truth. The less tangible money is, the more power can be concentrated. By the late 20th century, technology enabled money to move instantly across the globe. Swift networks, electronic transfers, and eventually cryptocurrencies transformed the financial landscape. What once required physical movement now required only permission, and those permissions were controlled by institutions with nearly invisible authority. The origins of digital money can be traced back to the 1960s and 70s, when banks began experimenting with electronic funds transfer systems. The first electronic payment networks allowed banks to clear checks and deposits digitally, reducing physical cash dependency. This might have seemed like an efficiency improvement, but it was the first step toward making financial systems opaque and centralized. Digital records replaced tangible assets, and citizens' money became data points in ledgers controlled by banks. Key innovations like credit cards and automated clearinghouses expanded this power. Suddenly, your money could be frozen, tracked, or manipulated without your knowledge. Inflation, interest rate changes, or policy shifts could silently erode value, and the average citizen often had no recourse. By the 1990s, online banking and digital transactions were mainstream. Money was no longer physical. It existed only as numbers and accounts. It's controlled by a centralized system with near total discretion over how it moved, who could access it, and under what rules. The rise of the digital revolution in finance accelerated in the 21st century. Mobile payments, online banking, and international electronic transfers made physical cash almost optional in some economies. But there was a hidden cost. Digital money allowed unprecedented surveillance and control. Every transaction leaves a digital footprint. Governments, banks, and even corporations can track spending patterns, control access to accounts, and enforce policy in ways that were impossible with cash. The creation of central bank digital currencies, CBDCs, represents the next step in this consolidation of power. Unlike decentralized cash, CBDCs could theoretically allow central banks to control exactly how money is used, where it flows, and who can spend it at all times. Citizens' financial privacy could disappear entirely, while institutional control becomes absolute. Meanwhile, the rise of cryptocurrencies like Bitcoin promised freedom and decentralization. Yet even this innovation has paradoxically reinforced centralized power structures. Governments regulate exchanges, enforce taxation, and can control entry points to the crypto economy. The system appears free, but access is mediated by law, infrastructure, and technological control. The breaking point. The 2008 financial crisis was the first global test of digital money's power consolidation. Banks were heavily interconnected through electronic financial instruments, including mortgage-backed securities and credit default swaps. When the system collapsed, governments injected trillions to stabilize banks, digitally transferring money almost instantly, far faster than citizens could react. Ordinary people lost homes, savings, and jobs, while digital money allowed institutions to absorb shocks invisibly. Notice the pattern. Failure becomes untouchable for institutions, but catastrophic for citizens. The tools are digital, the control invisible, and the average person has limited agency. The crisis highlighted how digital money transformed power. It ease and teaches wealth. It as a command over the system itself. Fallout and failed fixes after 2008, new regulations like Dodd-Frank attempted to stabilize the system. But the law reinforced digital power rather than distributing it. Stress tests, electronic oversight, and liquidity guarantees ensured banks could never truly fail as citizens continued to bear the consequences of public debt and inflation. Even digital innovations meant to democratize finance mobile banking. Fintech apps, peer-to-peer transfers often operate within the same centralized frameworks. Users are encouraged to trust digital systems that are ultimately controlled by institutions with near-total discretion. Failed fixes reveal a persistent problem. The system itself is designed to protect centralized power. Crisis management, bailouts, and digital ledger technology guarantee that institutions remain untouchable while citizens remain dependent, tracked, and financially constrained. Modern parallels today: the global economy is dominated by digital money. Over 90% of all money exists as electronic entries. Physical cash is a shrinking minority, shockingly. Digital money allows central banks and financial institutions to manipulate entire economies in real time. Adjustments to interest rates, quantitative easing, and digital liquidity operations can move trillions of dollars instantly, often without public awareness. The COVID-19 pandemic provided a live example. Citizens experienced unemployment, eviction threats, and depleted savings. Meanwhile, banks expanded digital credit lines. Governments injected trillions into digital accounts, stabilizing institutions almost invisibly. Digital money amplified institutional power while public vulnerability remained tangible. Emerging technologies from blockchain to artificial intelligence are reinforcing these patterns. Algorithms now determine who gets credit, who can trade, and who can access financial services. Power is increasingly encoded into software, law, and networks untouchable in the traditional sense, yet capable of shaping every economic decision in the world. 3 clear takeaways. Digital money centralizes power. Physical currency allowed some agency. Digital currency places control in the hands of institutions, often invisible and untouchable. Surveillance and control are inherent. Every transaction leaves a digital footprint, giving banks and governments unprecedented insight and influence over individual financial lives. Failures are absorbed differently. When crises occur, institutions are digitally insulated from risk, while citizens bear the brunt, demonstrating the asymmetry of modern financial power. Warning: open-ended thought: the shift from cash to digital money is more than convenience, it's a transformation of power. Citizens may soon operate entirely within systems that track, control, and influence their financial lives without meaningful recourse. The real question, whether digital money is efficient, as whether ordinary people retain agency over their wealth. If power continues to become untouchable, will we ever be able to participate freely in the economy? Or are we already living in a system designed to make us dependent, visible, and controlled? Call to action: if this insight changed the way you think about money, power, and finance, hit subscribe, ring the bell, and share this video. Understanding the digital transformation of money is the first step toward reclaiming financial agency in a world where power has become almost untouchable.